Hi, I'm James Dunn. Welcome to the Inside Network.
I'm James Dunn, and I'm going in depth today with Clinton Arentz, Head of Lending and Property Assets at Trilogy Funds. Welcome, Clinton.
Thanks, James.
It's a real pleasure to have you on the call to discuss property funds during this changing market. And I wanted to start off, Clinton, with a question about the rate cycle that's clearly well on its way toward normalisation, as in rising. How do you see that impacting the property sector as the Reserve Bank's rates movements play out?
Well, to lift your word up and utilise it again, normalisation, I think, is the key. The last few years have seen some pretty heady times, basically driven by lots of factors. But I'm hoping the markets will normalise over the next 12 months and we'll go back to long-term trend lines.
So what effect is the rising interest rate environment having on the property development and construction markets in particular? And given the backdrop of the rising inflation that has really caused the rate response?
Well, of course, it's so topical at the moment, so we're feeling the heat of these adjustments right now. But they're necessary adjustments in the way the Reserve Banks and central banks have telegraphed this over a longer time. It had to happen. We needed to get back to long-term trends, as I mentioned, on interest rates. I think it's positively healthy for the market. It sorts some of the weaker projects and weaker players from the stronger projects and better players. We're very much sorting our book at the moment to make sure we focus on the stronger, more experienced players with well thought through projects, James.
It's quite amazing, Clinton, to be sitting here after 2.5 years after the blackest of black swans that emerged to flap its ugly wings. The pandemic, the markets were obviously hammered by that, and following that and flowing on from that, severe supply chain disruptions. It was amazing to think, Clinton, that some property sectors were physically barred from having tenants and guests come through them, and that's something that nobody ever envisaged. But overall, let's stretch it out to 3 years. How would you describe the 3-year period that Trilogy's borrowers have just, well, endured is the correct word, isn't it?
Well, they've been extraordinary times, haven't they? Starting by global pandemic, as you mentioned, but the chain events that flowed from that were quite extraordinary. So they've been challenged, but we work with our clients very closely. We offer a very personal service for that reason, help them on the journey along the way. So I've seen trades and builders and developers adapt readily to this new world order, and I think I've been pleasantly surprised by how versatile and how adaptive these groups are. So the stronger, more experienced players, the ones who've been through multiple cycles, just get on with it and adjust to this new world order as they have to do.
So do you feel that ultimately it comes down to relationships, and if you have the right relationships with the right groups, the fluctuations in the external circumstances can be, well, not ignored, but you can be relatively confident in getting through them?
Manifestly, the key is always the quality of the people involved. I mentioned earlier, anything that comes with too much hubris or that it's overhyped is a good thing to step back from pretty quickly. But the more steady players, the ones that want to work with us, where we can add our value as well across a broad suite of services and skill sets that we have as a lender, matching up with these borrower groups and their skill sets, working collaboratively, month by month, week by week, day by day, to ease those little congestion points and keep the projects on foot, on track, and coming home in the right order. And I'm pleased to say we've been able to do that through our book, and our borrowers have been remarkably adaptable at that process. So full credit to them.
It's almost cruel, Clinton, that once the pandemic subsided a little bit, geopolitical crises emerged, and that flowed through into very severe supply chain disruptions to which we've alluded already. But we've seen these factors impact quite a few builders in recent months, and really they have to, because the prices of the inputs are jumping so much. How does Trilogy manage the monthly income trust in order to mitigate these risks for its investors?
Diversification and scale, two key elements. We're well diversified. We've got considerable scale. We've got excellent support with back of house people and systems. And as I say, we do it in a very hands-on approach. We've had to adapt as well, and we've been, adapting our approach virtually every month right through this last 3-year period. We've brought the investors along with us on that journey as well. So both borrowers and investors have been well educated, and we've done our bit to try and keep the communications flowing well. And as a result, I think we're starting to see some light at the end of the tunnel now. People are just getting used to some of these adjustments, and the better projects are still coming through. All thumbs up.
So what is the best positioned property sector right now in your view? Is it residential, retail, office or industrial, or even some of the newer subsectors that have emerged?
Well, you mentioned, builder stress before, particularly in the housing market. I mean, that housing market was force-fed for a long while through the stimulus programs, and that's now having a consequence. Every force has an equal opposite force somewhere else, and so we're still seeing some of the knock-on effects of those stimulus measures. But what we're also seeing is that that's settling down a little bit. That was particular to the home sector, and you could well imagine when they had so many forward orders and then couldn't get supplies, how much trouble they might be in. Our model's a little different in terms of the types of builders we use, and of course that diversification element, which is key for us. So we're seeing supply chains opening up a little bit now. They're still sticky in places. It's not a perfect supply chain, but it's improving. Costs are somewhat stabilising, and interest rate adjustments will help smooth that out over time. And long-term inflationary pressures we expect to reduce over the next 6 or 12 months, James.
So flowing into a sector view, that sounds like you're still very keen on logistics.
Well, once we open up supply chains, there'll be many more goods come through. And of course, we've also seen the rise of online selling in sequence with that forced upon us somewhat by COVID, but the technology was there anyhow. So both those elements support industrial and logistics space. And that's not just an Australian phenomenon, that's a global phenomenon in the Western world. But I think residential, once it resets, will still be strong. We haven't seen the quantums of oversupply in past cycles. If anything, supply is tightening, so we're likely to see a pickup in demand when confidence resumes over the next, hopefully, 6 or 9 months or so.
Clinton, retail and office were hammered by the pandemic, really unforeseen circumstances that physically kept shoppers and away from shopping centres and workers away from their offices. Yeah. So, and that's often talked about as only exacerbating trends that were already there. So how do you see retail and office recovering? Will they get back to the way people viewed them before?
Well, I think retail's changed a little bit. You do have the online sales and of course the point of delivery service. But I think there's always a need for high street. Communities love high streets, and we've seen high streets traditionally. We see them re-emerging now. I see people in the CBDs, Sydney, Brisbane, Melbourne, as I travel there now, re-emerging pretty quickly to mix and mingle. So I think that side of it is strong. Commercial office space, a little more subdued. Some of the bigger companies have developed longer term work from home practices. But for the same reasons, people need to cluster, they need to collaborate, they need to share ideas and pool resources. So I think the myth of a dead CBD is well expelled. We see CBD developments across all 3 cities that we focus on. As I said, the 3 primary states, there's new commercial office developments and they're sponsored by large-scale international capital providers. So I think that's the message there. We expect that to resume in the normal course and maybe done a little differently, a little bit more WeWork, a little bit more informally, but definitely there's a need for CBD clustering, most for sure, James. Yeah.
So in general, Clinton, and in summary, how do you see the property markets performing over the next 3 to 5 years, and how should that performance in theory affect an investment in the trust?
Well, I think how they'll perform is they'll take a breath, and as we talked earlier, normalise to some extent. I think that's a tremendously healthy thing. It's healthy for the country. It's healthy for the property market. It's healthy for our loan book in that sense. And if anything, we're seeing better quality borrowers come to the fore. Those borrowers that aren't quite as spooked by the latest headlines, that do have underlying business strategies that are multi-cyclical and perhaps in some cases multi-generational. So, so we see quality borrowers, we're seeing quality product offerings. As I said earlier, there's a sorting process. Some of the weaker projects will be eliminated quickly. So for our investor base, I think it's quite supportive because we see quite a strong book. We see the projects in that book progressing well, which is, as I said earlier, a credit to the adaptability of those smaller builders and developers that can find ways around obstacles and problems. And as an investment class, James, I think it's a very high quality offering in that regard, given its diversification, relatively low risk, and our day-to-day hands-on approach.
I've been in depth with Clinton Arentz, Head of Lending and Property Assets at Trilogy Funds. Thank you very much, Clinton. It's been a pleasure.
Thank you.